Hi fools, I'm Sonia and with me is Nate Weisshaar, Senior Analyst at the Motley Fools Champion Shares Pro and Share Advisor Service here in the UK. And we're here to take a very quick look at how to find strong dividend payers for your portfolio. Now Nate, we know that a lot of companies are sitting on huge piles of cash at the moment. Is this a good sign or a bad sign for investors?
Well, it's always good to have a company with a strong balance sheet. So a certain amount of cash is always reassuring. But too much cash makes me a little nervous. Management tends to get a little itchy, and they tend to act a little bit like kids going through toy stores and buying things they don't need and don't make shareholders any better off.
Okay, so having too much cash isn't, even though they're in the best position because they've got the cash, that doesn't necessarily mean they're going to offer the best returns for long-term shareholders.
No, I mean, just like you and I, saving today, piles of cash aren't earning a whole lot of money, and we'd like to see companies putting this cash to work, either investing in the company or giving it back to us as shareholders so we can do something with it.
Okay, so what can income-seeking investors look at if they want to get the most bang for their bucks?
Well, if you're looking for a good dividend-paying company, there are a few hallmarks that you need to look for. One of them is strong, steady cash flow. Companies like Unilever, who have products that will be bought in good economies and bad, they provide a pretty defensive situation, and that's why those dividends are viewed as pretty safe. You also want to see a good dividend cover. Do they have enough cash coming in to support the continued payment of the dividend? If business slows down, does that threaten the dividend? As an income investor, you don't want to see your dividend cut, so that's something you should be very aware of. And then one of the things that a lot of income investors look at is dividend yield. They're attracted to high-yielding shares. This can be good, but it can also be bad. Sometimes yields are high because the company is in decline, and the dividend payments have not caught up to this, but the market is looking ahead. Other companies are high dividend payers. GlaxoSmithKline and AstraZeneca are good examples of this. They've got very high margin businesses that generate lots of cash, and they're relatively defensive. So they're able to kick off a nice dividend return for shareholders. But one thing that income investors often overlook are the lower yielding companies that are increasing their dividend every year at impressive rates. One example is Dignity, a funeral services company. They only yield 1.7% right now, but that dividend payment has been increasing 10% per year over the last 5 years. That's really good, a pretty nice growing income. It's not just a bond necessarily. You get your income is increasing well ahead of inflation.
Okay, so we're looking at sustained growth there, aren't we?
Yes. Right. Yeah, you don't want the dividend is usually a communication from management as to how they see the business going. So most people think dividends should be steady. You don't want to see dividends jumping around because that tells you management isn't quite sure where the business is going and how much cash flow they're going to need.
Okay, well, thank you very much, Nate. I hope those pointers have helped you. So in order to find some strong dividend-paying shares, you need to be looking at dividend growth and not just chasing yield, strong, steady cash flow, and we need good dividend cover. Brilliant. Well, I hope that's helped you. Thanks for watching and happy investing.